Welcome to another episode of Your Next Trade called today Breakout coming. So summer is almost over. We are now in September. Last week we had the NVIDIA earnings where the numbers came a bit better than expected, but the expectations were pretty high. So as we're going to see later, the market reacted not very badly on the numbers. The stock was down 6% on the day versus expectations of a move of 9 to 10% as we underlined last weekend. But really not a lot of follow-up for NVIDIA. So now September, the market, as we can see in this chart, so this is for the S&P futures, the ES. Since the 19th, 20th of August, the market has been trading in a range. We are talking, 55.80 to 56.60, really a 60 to 70 points range. And where most of the volumes are, you can see were around 56.30. So we had a good close on Fridays thanks to the end of the month. So you can see the move that we are here. But really, when you get consolidation after such a big move that we had in August when we went from 51.50 to 56.50. We consolidated over the last 10 days and now the market is ready for another move, as we're going to see later, and that really strongly advise you to stay until this end of these videos to explain to you how is the positioning of the market and to understand what are the odds of a breakout going forward. So for the year-to-date asset performance, it's more or less the same picture as last week. So stocks very strong. Overall, the dollar flattish, but same with the week-to-date asset performance, where the stocks, we are talking S&P and Nasdaq roughly flattish. Nasdaq down 1% due mostly to the NVIDIA being down. Rest of the world has been small up. What is interesting is we saw a bit of strength from the US dollar, but that needs to be taken into perspective. Why? Because the dollar was down 4% last week, as of last week, versus the euro, for example, and only down 3% for the month. So which is still a big number. A lot of USD weakness over the month. Some weakness as well for the crypto world, and we saw as well commodities a bit weakish. Let's jump immediately to the week-to-date industry performance, where we see here the leaders were financials and insurance. So I strongly advise you to look at the banks, to look at the charts of JP Morgan, which is now at 225 US dollar. So that has been really the leaders of this market over the last 5 sessions. When financials are doing well, normally the market overall is doing okay. Other end of the spectrum, silver, retail, solar, semiconductors. Why? Again, because NVIDIA was down on the week. So if we jump into the sector's performance and we look at the week to date, you see that IT, information technology was down 1.6%, but overall market did pretty well. So all in all, the market breadth of the market was pretty good for the week, despite NVIDIA being down. What about the rate? So rates, we are kind of small up on the US 10 years at 3.9. So the PCE for the inflation that came on Friday and the University of Michigan as well were lower than expected, but it's almost like, we had such a big move on the US 10 years where we rapidly moved from 4.50 to 3.8 that now the market is a kind of swallowing this big move. For the I'm interested into the yield curve. So this is something that we discussed on Thursday and Friday on one of the Discord channels, because one of the users was asking me, how do we call when we go from negative to positive? So we get a re-steepening of the yield curve. So what happens is the inversion of the yield curve, the 10 versus the 2, is very often a very good leading indicators. But what is very true is when we go from negative to positive, that it starts to smell not that great. In other words, when we go from negative to positive, this is very much the sign of the odds of a recession on the way up. So I know that has been not very working over the last 24 months because, as a leading indicator, but generally, this is more when we go from negative to positive. Looking at the Fed funds expectations, this is the same as last week, and what I want to underline that we did last week. So what are the expectations? Right now we are at 550 versus 455 at the end of December. So in other words, the market participants are expecting 100 bips, 1% cut between now and the end of the year. We do have 3 FOMC meetings. So if you divide this 100 by 3 FOMC meetings, that tells you that the odds of one meeting being at 50 bips is pretty high. What about September? September, we are pricing now 0.3%. So 25 bips plus another 5 bips. So in other words, we are closer to having a 25 bips cut than 50 bips. What's going to be very important is obviously the NFP numbers that we're going to have next Friday, because the Fed has been moving from only looking at inflation to mostly looking now at the job market. What you can say from this overall market is, if you look at the politics through the deficit, the US deficit, if you look at the Treasury, if you look at what the Fed has been doing, overall, those 3 components have been very accommodative for the market. We are running in the US between 6 to 8% deficit. The Fed, despite what it has been saying, the inflation is way above the 2%, and it's going to be way above 2% at least until the start of 2026, and the Treasury has been as well very accommodative. So those 3 factors have been helping the economy. What we saw in August is a bounce in the retail sales. So one of the struggle was until let's say end of June, the US consumer was kind of doing the same as the end of 2023, but not months on months and year on year, not looking as good as before. We had 1 month, maybe that's 1 month only, but that helped the market, where we went from pricing not only to the end of the carry trade, but to mostly as well of the possibility of recession into the US. And these odds of a recession have been massively coming down to those retail sales. So going forward, as we are going into the most important part of the year for the retail sales, which is going to be October, November, and December, that's going to be very important. And as well, the big factor, the big catalyst is obviously the US elections at the start of November. So this is a big one. There are a lot of unknowns, and going forward, we need to keep a strong eye on the US consumer. What about the VIX? What about volatility? So we are at 15%, so below the 16% let's say threshold. Volatility has been coming down. This is the same as before. When we had a spike, a lot of structured product came to sell volatility. So let's jump quickly into the technical analysis, and what I like to do when we are at the start of the month is looking back through the monthly. So you go on TradingView, and instead of selecting one day, you select 1 month. And here we are looking at the S&P futures, and as you can see, a strong bounce on the candle. So that is pretty much a positive signal. This is the same with the Nasdaq. This is the same with the Russell. You get a lot of actually many assets that look the same in terms of the candle. Why? Because the correlation between markets over the last few years has been close to 1. It's almost like people are buying the same market, not the same market, but really correlation, the beta is at 1. So if we look here at the stock 600, which is for Europe, if you look at DAX, this is the same. That is not really a bearish chart. And if we look now at the currency to the euro dollar, so you saw the weakness that we had on the dollar in August, same with the versus the yen. So really, if you look at most of those charts, if you look at those big candles, when you manage to bounce massively from the lows, there is a good chance that you're going to go higher, and there's going to be breakout, at least for the S&P, for the Nasdaq. So this is for the technical analysis. If we go back into our spreadsheets, looking at what happened for the week, so starting here with the S&P futures, this is the trading range that I've been mentioning, between 56.60 and 55.60 here, but mostly it will be 55.90. So 70 points range, where most of the volumes were was around 56.30. Now we do have like catalysts going forward, as we're going to see later, in terms of macro, in terms of options, and obviously with the elections coming. So what about the NVIDIA? So NVIDIA was down 6% on the day of the earnings. Why? Because this is mostly about the multipliers that we have here. So here I shared something that we built in the 4x4 videos, which is understanding, how a company has been doing in the past. So that's for NVIDIA and how the market is expecting in the near future. So since 2023, NVIDIA has been experiencing more than 100% sales growth. And we are talking sales growth on 20 billion plus sales. So this is like unheard in terms of revenue growth. And in the meantime, as you can see, the margins, we are talking, 56% net margin. So imagine that then on 100 billion plus, you do 56% margins. In the meantime, obviously, when you start your journey, you'll be looking at PE. I don't think PE is enough. I know that some educators will be misleading you. Very quickly, you will understand that PE is just one tool, but clearly not enough. So I'm interested as well into all those ratios that I have, and you can do more than that. But in other words, if you look at 2025, for example, you will be paying 16 times revenues for NVIDIA. Think about it, 16 times is quite a demanding number, and that's an understatement. 25 times EBIT, we are talking 23 times EBITDA. So in other words, we are talking very demanding multiples. Obviously, we can go higher, but the market is taking a breather, and we need to have more catalysts for the space of artificial intelligence / semiconductors for those stocks to go higher. I'm interested as well into the volatility that we saw over the last 5 sessions in the retail space. Here we are talking about the Dollar General versus BBY, Best Buy. And as you can see on the day of the earnings, one stock was down more than 30% in blue, and another one was up 14%. So for those of you who think that, a pair trade is not working, that is a very good example that in the same sector, in the same industry, you can be finding a winner and a loser. Why? This is about ID generation and understanding the drivers. But looking at Dollar General, what is very clear, as we are talking about a company that is targeting, the low end of the consumer, we are talking, people making a bit less than $30,000 to $50,000. This part of the US consumer has been really, really struggling. So when there is so much inflation in the system, the low end consumer is really struggling, and that's true for names like Dollar General. That is true as well for Five. So that is interesting for your ID generation to understand, which part of the US consumer is struggling. If we look as well at what happened for the week, we had the PCE, as I said, for inflation. So Friday a bit better than expected. We had the end of the month. So that is the spike or end of the month. Very often in the last hour of the trading of the last day of the month, we will see a funny move, and that's why we moved to 56.60 on the S&P futures. And so far, what we can tell is good numbers from the macro have been seen as good for the economy. And why I'm saying that? Because on Friday, looking at the catalyst, we get the NFP. So we get the job data coming. And as you remember or not, in August, the numbers was not that great. The market reacted by going down by 1.8%. We were in the middle of the unwinding of the carry trade on that Friday, and the market made new lows on Monday and then bounced. Okay, and this is if you look at the NFP numbers, this is when we had volatility, the VIX at 27%. Then on the next Monday, we went at 60% plus. But overall, these NFP numbers, we always say, this next NFP numbers is very important, but this one is pretty key because if you look at August, most of the data after that, the macro data were pretty good, and the market say, okay, a good number is good for the market. Whereas, if we get another bad NFP number, on one end, you can argue, okay, it's good because the Fed will be really cutting by 1% until the end of the year. But that tells you that the odds of a recession are coming back up again. So I will be really looking at these Friday numbers where NFP bad will be bad. We do have a lot of macro for this week. This is very much the case at the first week of any month. We got the ISM manufacturing. Before that, you get the Eurozone China manufacturing PMIs. We get the ISM services on Thursday. Remember that tomorrow on Monday, US market are closed, so it's going to be pretty boring. We had over the last couple of weeks some low volumes in the overall market, but first week of September, most market participants will come back to their desk. So we'll start to see some pickup. In terms of earnings, not that many earnings. We do have like some interesting earnings though, so I will be looking at those names. So in terms of positioning, in terms of options, I'm always interested into that because we do know that the market is very much, I'm talking the cash, is more and more driven by the option market and the positioning. What we have seen is more recently a grind higher, and the positioning that is very much the positioning that we had before, where people have been buying out of the money calls and making the market makers forced to be buying the market. So it's easy to say it. I just want to verify it with you. So I looked at the S&P that are maturing, for the options that are maturing at the end of September. So where I'm interested is this open interest column. As you can see, or not, if I manage to, so the 5700, we do have like roughly 5,000 contracts. If we look at the 5750, guess what? We get 45,000 contracts. So this one here, this 5750 is a big magnet for the market, and there are really good chances that we're going to be grinding higher, and people are kind of scared as they were before to be missing the market on the way up. So if you look at when we started this call, this presentation, we say the trading range had been 55.80, 56.60. Now we see that, you know, with those calls that have been bought, that there are good chances that we go higher. If you look at seasonality, something that I mentioned last week, to me, there is a good chance that there's going to be some funny moves going into the big expiry of September. Then I will see, you know, the chances, the odds of a bit of correction going forward. Why? Because, you know, seasonality is not that great. I think you get closer to the US elections, which will be at the start of November. So for this week, a lot of macro positioning is on the way up. Market is expecting a plus minus 1%, 1.3%. Again, a lot of macro, Europe, US, and China. We do have like the Chinese manufacturing PMIs on Monday. So this is it for the catalyst going forward. I've been booking more and more mentoring for this end of the year and for the start of next year. So if you are interested into mentoring, you should hurry because the seats are getting less and less. For the community, this is the same as before. You can join us on the trading community. There are some free channels, or if you've subscribed to the 4x4 or if you've done the mentoring, you get free access to them. And any questions, you can send me an email to greg@duponttrading.com. This is it for me for the week. Have a good trading week. Bye-bye.